Welcome back to the Profit Punch channel. If you're tired of buying stocks at the wrong time, whenever you buy the stock falls down, or you buy it and a few days later it comes crashing down, this is a video for you. In this video, we're going to study the only 3 times stocks are worth buying. And of course, this is not financial advice, but this comes from my experience as a stock trader for about the last 5 years. Now, this video is tailored to both long-term investors and swing traders. If you're a day trader, there are several lessons you can learn from here, but I am not a day trader, so this might not fully be applicable to you. But if you're a swing trader and you work from the daily chart, or a longer-term investor and you work on a weekly chart and onwards, this is going to be super helpful. Now, the secret to buying stocks at the right time, or the only time to buy stocks, is the environment. The environment is everything, because you will find that in a good environment, you're going to have a 40% to a 60% win ratio. And this means that if your risk to reward ratio is 1 to 2 or 1 to 3, you're still going to be profitable with these percentages. So these are great winning percentages. And this is when you'll find that setups are working, those things of double bases, cups and handles, sheets, double bottoms. They're all in this nice environment, right? If you want to make sure that you're in a good environment, of course, you have to find a primary market for those stocks. Now, 90% of stocks in the USA market will follow the USA index. So that's the S&P 500 or the NASDAQ 100. But then there are some stocks like Alibaba, which will follow the Hang Seng index. Or if you're trading commodities, stocks like AU or HMY, SBSW, which are gold stocks, are going to be following the gold commodity index. And of course, silver stocks will do the same, coal. So you have to know, is it a commodity stock? Is it coming from another country? Or is it based on the USA market? Then you find the primary market, and that is the market we're going to be talking about later in the video. Now, in a bad environment, you don't want to be touching stocks. And that is because I found that only 5% to 10% of trades will work. This means that if you have a 5% winning rate, that means you need a 1 to 20 risk to reward ratio in order to make money. Now, this is almost impossible in the stock market. Now, it does happen 1 in a million times, but it is not something that you want to be counting on. Even a 1 to 10 risk to reward ratio is rare. For example, if you had a 10% win rate. So you don't want to be investing in this environment. So you normally want to avoid the market entirely. Now, of course, it might not be possible to avoid the market for people like me who have itchy fingers. What you can do is greatly reduce your risk. So maybe you can risk 0.05% of your account, but that is just to help you get a feel of the market. You just want to see, is the market now responding to me? Now, when the market responds to you, then you can start to invest more. Now, in the bad environment, this is when you'll see a perfect setup, but then it fails. The breakouts are going to be failing. It breaks out for a few days and it's going to crash. Nothing is trustworthy. I'm sure if you've traded for a while, or if you're new and you started out in a bad environment, this is something that has happened to you, and I apologize. That is your experience. If you're enjoying this video and want to build financial freedom using the stock market, I put together a free guide called 10 chart patterns that make money. It's based on the exact system that we use at Profit Punch, a financial newsletter and educational hub that sends you A+ stock setups where we tell you exactly when to buy and sell, and also will teach you stock trading from the ground up. These are the same patterns that our members use to catch moves like SMCI 250%, Nvidia 200%, Applovin 350%. The guide is short, visual, and beginner-friendly. Just click the link in the description or pinned comment to grab your free copy. Now back to the video. As a swing trader, which is something which I like to do, a bounce off the 20-day moving average in the primary index is a time to look for short-term swing trades, which are going to give you maybe a 1 to 2, 1 to 3 risk to reward ratio. And when the index is bouncing off the 50-day moving average, then this is when you can look for longer term swing trades, which might give you maybe a 1 to 4, 1 to 5 risk to reward ratio. And then also the third time is after a deep stock market recovery. Now, of course, here you don't want to swing trade because you're going to miss out on a bigger part of the move. What you want to do is try to find good stocks which have held up very well in the market correction, and then you can hold them, swing them for a very long time, like almost 3 months. Then you can get the meat of the move. Now, for a long-term trader, the same rules apply, but you avoid the times when the market is correcting to the 20-day moving average. You only focus when the market corrects to the 50-day moving average, or if the market is coming from a deep correction, maybe it has recovered maybe 10%. So what you will find, as I'm going to show you later in the examples in this video, is that when the market is correcting, the stocks which you're going to be wanting to buy, that's the time they're using to make these setups. That's the time it's going to be doing the cup, right? That's the time it's going to be doing the handle. So this time when the market is falling down, these stocks are not going to crash. Rather, they're going to use the time to create setups. This is just normal human psychology. So you want to always be looking out for stocks that are holding up in the market. So whenever the market starts to go down, this is when your work begins to start watching the market, which sectors are strong, which stocks have refused to fall down. Now we're going to go through real world examples, and I'm going to show you very interesting findings that really change the way I look at the market. Okay, so our first example is Hood stock here in 2024, and you can see what is happening. So here we have a deep market correction. So these vertical lines align to what is happening here in the stock chart. So here we have a deep market correction. So Hood corrects. So you can see that here on the NASDAQ 100 as well. And then while Hood is forming its handle, the NASDAQ 100 also pulls back to the 50-day moving average. And then that's when Hood starts to break out, right? Every time the NASDAQ pulls back to maybe say the 20 here, you can see Hood from the cheat. And then we can see that Hood went up 216%. Let's say you missed out on this buying here. Then another time to buy was on this gap up day. And that was also right after the market had pulled back to the 50-day simple moving average. So that was a good time to buy. And from there, you could have gone up still 137%. Very nice buy. And then Hood goes up very nicely. And then while the market does whatever it's doing here, simple correction, Hood forms a very small cup and a handle here, has a gap up day. So this is something called a buyable gap up. So you can see on that day it's gapping up. And then this can be a swing trade. But if you're already holding it as a long-term trader, then you could have just continued with your move. And then you can see that the stock tops out while the NASDAQ is also topping out. Now, how could you have known that you should get out of the stock? Now, of course, this is something called the fillable gap. So the stock gaps up and then fills the gap just a few days later. So this is a huge sign to get out of the stock. And then also this is base 2. So stocks normally fail after 2 to 3 bases. So this is a base 1, this is base 2, which is a swing trade opportunity. And you know that after base 2, you should start to look to get out of the stock. So those are several things that you should have known before the stock topped. And then we see Hood does the same thing again in 2025. So these things happen every year. So you see while Hood is forming this very deep correction, so it literally corrects 50%, forms a very deep correction, a nice cup with a handle. So you see while there's a correction, there's also a bear market here. And then while the market is pulling back to the 20-day simple moving average, that's when Hood is forming its handle in the sheet, in the cup and the handle. And then it has a buyable gap up day here, which is a good time to buy it. So about 7th, 8th May. And then from there, Hood went up about 200%. So you still had a very nice profit. You had no reason to get out of Hood until around here. Why again? Because this is base 1 during the market correction. We know that after base 1, we always expect a base 2, unless there's a special condition that we're going to talk about later in the video. And after base 2, this is also a swing trade. We see a buyable gap up here. So we see that Hood likes to do these gap ups. And then even if you swung trade the gap up, you could have gotten maybe about a 40% gain maximum. And your risk maybe could be about 4%. So still very nice gain in a very leading stock. So that is Hood for you. The next example is Applovin in 2024. So this is one of my favorite stocks in 2024, made a very huge gain. So remember, base 1, base 2, after base 2, stocks become very finicky. Now, some stocks could go up to base 3, base 4, but those are very risky bases. The most trustworthy bases are base 1 and base 2. Base 1 normally comes during a market correction. Base 2 is normally the first time the stock will pull back to the 50-day simple moving average, and you can go from there. So you see this very long base 1 from several weeks. This is a very perfect cup and a handle. So we see a bear market. Also, the stock will correct about 30 to 50%. So this one does 35% correction. And then while the market is pulling back here, you can see that's the time Appfolio uses to set up this handle. Now, this is why I'm trying to say that don't try to be in the stock market while the stock market is crashing, because even the good stocks like Appfolio, which did a 500% move, it wasn't going up. It was waiting, right? And as soon as the stock market ends this correction, as soon as it jumps over the 20-day simple moving average, that's when Appfolio breaks out in very huge volume. Here, my buzzer color coded, the green bar means there's very high volume on that day. Even if you bought above the high of that candle, which is a good time to buy still, you had a 500% gain in this stock. Your money multiplied times 5. If you put in $10,000, you got $50,000 at least. So it breaks out and then has this crazy huge run. You don't have any reason to sell it because it hasn't closed under the 20-day simple moving average, which I show you here. And remember, after base 1, we normally expected base 2. But of course, one special condition is after a very long run like this, you can even just sell at the end of base 1 because normally stocks won't form a base 2. If they form an elongated run like this, they'll just tire out, right? So this one, I will say I did not expect a base 2, but still, it gifted us with a base 2, which we know after this, not trustworthy. Stock gaps up and then fills a gap in a few days, which is also a very bad sign. And also, this is base 2, another bad sign, because after base 2, that's the last time you ideally should be swing trading. The stock corrects, and then it has finished its 500% move. Next example is Interactive Brokers. This one also had an 80% move. Now, 80% might not look very impressive, but what makes it impressive is that Interactive Brokers has a very small average daily range. So in a day, it might move only 3%. So if it's moving 80%, that means it has moved almost 30 times what it normally does. But some stocks like Appfolio might move 500%, but really they move 10% in a day, for example. So that means that it's moving 50 times, which almost is equivalent to the Interactive Brokers movement in terms of relative movement. But in terms of absolute gain, then it is not as impressive. Okay, here we have the chart of Interactive Brokers versus the NASDAQ 100. Once again, you can see that nice cup and a handle. It forms during a market correction. So these patterns don't form out of nowhere. They form while the primary market normally is correcting. It's on rare occasions that maybe a special industry on its own is lagging behind, but the market is doing well. Normally, it's going to follow the market. Then while the market is finalizing this correction here, that's when Interactive Brokers formed its handle. Now, one trick about the handle is that you want this handle to be less than 3 times of the average true range. If it's less than 3 times of the average true range, that's a very good sign. And then it breaks out on this high volume day. So this is the day to buy. It breaks out of there. So let's say you bought here $31. You must have held it. You hold through earnings. That's a very good profit. And guess what? Your risk should have been only just that gap up there. So this is what makes this beautiful. Your risk would have been 1%. A 1% risk to make 90%. Come on, guys. This would have been a sweet profit. So if you put in $10,000, you're risking $100 to make almost $10,000. These are the type of trades that you want to be getting. Now, of course, they don't happen the whole year. They happen maybe once or twice a year. That's when these windows come up. Anyway, so breaks out. Remember, after that, we expected base 2. So that was base 1. Then base 2, the market is correcting to the 50-day. Base 2 is when you can add again for a swing trade. Would have given you 29% gain maximum. Of course, there were earnings, which makes it even harder to participate in that swing trade. But you can see that as a long-term holder, you buy here, maybe you sell a little bit on the pullback, and then you expect it to bounce off again on base 2, so you can add back your stock, and then you wait for base 2. And after base 2, you can look to get out of the whole position. So that's the general run. Next one is SMCI in 2024, and then Nvidia. I hope you're getting the gist now. So SMCI is also a special story because it did not form a base 2. So this is what I was trying to say. Sometimes when stocks have this overextended move, then they will not participate in a base 2. That's why sometimes it's very important to reduce your shares while the stock is going into base 2 because you're not sure. But one good hint that I found is that the stock has gone through a very elongated move and it is having an abnormally long move. And then you can know that, okay, likely it might not form a base 2. So this one went through a 279% move. So your money went up times 3.5 at least. So if you put in $10,000, that means your account would go to $35,000 at least. So you can see that while the market is forming this very deep bear kind of market, then we can see that SMCI is literally just setting up, right? So that's why you want bear markets. This is when you can see the strong stocks that you should be pouring your money in when the market recovers. So as soon as the market recovers, guess what happens? SMCI breaks out. So the buying point ideally should be, there are two buying points. There's this one at $32 and then here at $34 because there was a gap up on this day. So it gapped up about, opened up at around a 12% gap, right? So you just buy it there on the gap up day, you get your 200% gain. You had no reason to sell until it closed under the 20-day simple moving average. That was also a very nice move. The next example is IT. Yeah, so it also had this 160% move. So same formula. While there's a market correction here, it's forming its nice gap and a handle, breaks out. It also gives us an opportunity to add. So it just doesn't run once it comes out and then comes and tests the high of the base. Very nice time to add to the stock. And literally you have no reason to sell it. Goes up, goes up. So what would be a base to here? So this is something which could look like something like an ascending base. Finally gaps up and then fills the gap in a few days. That's already a sign. Time to get out. So you get out with a very huge profit on it. Then after it, there is Nvidia in 2024, which the Profit Punch members participated in. Very easy and simple move. Okay, you're probably getting bored by now, but repetition is a mother of skill. So let's get this final chat out of the way so that you can master how to do this. Market correction, Nvidia is setting up. Nvidia forms its cap and handle. While it doesn't recover here immediately while the market recovers, that's the interesting part. It does it way later while the market is jumping off the 50-day moving average. So that's quite interesting. And of course, we can see the cheat over here. Okay, so what's going on with this cheat? It must be less than 3 times of average true range. So it's only a 5% cheat, the whole thing. As soon as it jumps out of there, goes above the high, I'm sure there's very high relative volume on that day. That's the time to buy. The first move is going to be 90%. Very nice time. You almost double your money. Then as it starts correcting, you can reduce a bit of your position and then you know you're going to wait for it. There has to be a base 2. So base 2 is forming here. That's when the market is going through its second correction. And then once it recovers to base 2, that's the time to add to it again. You go for a 60% move. And then we can see it forms something like a double top. So this is also another sign to get out of the thing. And then also the reason why you'd have known that, hey, the game is over is that you see this very huge bad day in the market. And also base 2 has just been finished. Whenever you have a crackdown after base 2, normally that's when, things are over. So after that, it corrected and yeah, it actually hasn't gone up way much higher after that. So currently it's at $180. From that high, it actually only has gone up 30%. So that's the beauty of catching these moves when you get them. Now, I hope you learned something from this video. I want you to master the environment so that you can master the trade. And of course, this is Profit Punch. Sign up for the newsletter. We tell you exactly when these trades are getting out. Right now, the market has been correcting and there might be some very good opportunities. If they arise, everybody in the newsletter will be getting those. So sign up for that. May the markets be with you.